A one-size mortgage does not fit all. On this week's Emily Now episode, I'll be talking about open versus closed mortgages, conventional versus high ratio mortgages, fixed versus variable. I'll walk you through a recent example of a client we had that was porting their mortgage and it didn't turn out quite as they had expected, so there's a few things to share with you there. And Canadians are taking on more debt. Is this good? I'll talk about an article in the Financial Post that ran and talked a little bit about that. So stay tuned. I think it's going to be a good episode. My name is Dylan Gallagher, founder of emilynow.ca. I've been a finance guy for the past 18 years, helping people borrow money in the form of either a mortgage or a loan. Last year, we launched a website called emilynow.ca where we're trying to make it really simple for people to borrow money to access the banks that have the money, and really trying to disrupt that industry and turn it on its head. And in an effort to help do that, we put together this weekly episode to teach you everything you need to know about debt, including mortgages and loans. That's where we focus. And it doesn't matter whether you're a business or an individual or a family, there's always lots to learn in these episodes. And so we'd encourage you to check out emilynow.ca. You can follow us on Twitter at @EmilyNowCanada. You can like us on Facebook. You can +1 us on Google. You can subscribe to us on YouTube. We're in the social space. We'd love to connect with you. Send us your questions. Follow along as we post throughout the week things that you might find interesting. And let's get started with this week's episode. And the first question, which is, what is the difference between a conventional and a high ratio mortgage? So these are terms that, if you're in industry, they're pretty normal. You hear these terms all the time. That's a conventional mortgage, that's high ratio, et cetera, et cetera. But what does that mean for you, the person out there that's looking or considering a mortgage? So conventional means that you're looking to borrow less than 80% of the value or purchase price of a property. And by conventional, we're also saying that you do not require mortgage insurance. You've got the resources, you've got the down payment, you have the ability to meet the criteria of the bank without needing mortgage insurance. And so a high ratio mortgage is the opposite of that. A high ratio mortgage means that you do not have 20% to put down, that you are going to require some mortgage insurance to protect the lender against the little bit of equity that you might have in the property and the decisions that you might make because of that. And so conventional, you have 20% or more to use towards the purchase of a property, or you have 20% or more equity in your property that's going to stay there if you're looking to refinance. And high ratio means that you do not have the 20% requirement. So you have 5% or 10% or 15% as a down payment for a new purchase, or if you're looking to refinance your property, that you're going to end up having less than 20% equity in the property once the refinance is over. So that's the difference between conventional and high ratio. Something to note is that when you look for a high ratio mortgage, meaning it's a high percentage, the mortgage will be a high percentage of the value or purchase price of the property that you're going to have to pay an insurance fee. And in previous episodes, we've talked about what the impact of that insurance fee is. So we'd encourage you to go into the archives and take a look. But if you're looking for a mortgage, conventional or high ratio, visit emilynow.ca to get started. You can walk yourself through the options. You can see what's needed. You can send your request directly to the banks. We'd be happy to help you with that. And we've got an amazing customer service team here that can answer your questions and help you put your deal together. So get started on that today. Moving along to the next question, what is the difference between an open and closed mortgage? And this is maybe a little bit more of a common vernacular, or you hear these terms maybe a little bit more frequently than conventional or high ratio. But in essence, an open and a closed mortgage is closed means that if you're going to repay the mortgage, at any time during the term. So say you get a 3-year closed mortgage or a 5-year closed mortgage, that if you wanted to repay that mortgage during the 3 years or the 5 years, that you're going to be incurring a penalty, and that penalty can happen one of two different ways. You're going to be charged 3 months interest, or you're going to be charged the difference between your interest rate and what the interest rates are today. So if you have a closed mortgage for 5 years and the interest rate is 3.1%, but you're going to be paying it out and the same interest rate for the same mortgage is 2.9, you're going to be charged a penalty on the difference in that interest rate. The idea being that when the bank gave you the money, they were earning 3.1. If you give it back to them and they put it out again, they're only going to earn 2.9. So you get to pay the difference that the bank loses. For an open mortgage, it's exactly the opposite. The bank is going to say, look, you can have our money, you can pay us back anytime with no penalty, and here's what the interest rate is going to be. I tend to think of open mortgages, when I explain it, more like a line of credit, in a sense that on a line of credit, you can repay that entire line of credit at any time without penalty, and an open mortgage functions exactly the same way. The difference is with an open mortgage that the pricing is not prime minus, but it's rather prime plus. So the bank says, look, today prime is 3%, but because you get the benefit of paying us back anytime with no penalty, we're going to charge you prime plus 2% or prime plus 3%. So it's important to know the distinction between an open mortgage and a closed mortgage. The reason you would choose one over the other really has to do with how you plan your cash flow. If you expect to come into a pile of money during the years that you're going to have a mortgage, you're going to want to have the ability to repay it without penalty. If it looks like over the years that you're going to have the mortgage, you're probably not going to run into a bunch of money, then you'll probably want to close the mortgage, so that way you know what your mortgage payment is going to be and you know that the interest rate will be fixed. So if you'd like to explore mortgages a little bit more to see what the impact is for you or what interest rates are for the various mortgages, visit emilynow.ca, open an account, put your information together, see what kind of options you have available, and if you need our help, of course, we're going to be happy to help you out. Recently, we had a customer come to us whom we had helped place a mortgage for a few years ago, and for a whole bunch of reasons, it was a 5-year mortgage. They're about a year and a half into it, or 2 years, and they've had some life events change their circumstances, and so now they've made the decision to move, and they'd like to port their mortgage. Seems pretty simple. So whatever the mortgage balance was on the old property, they would just like to port it across to the new property. So they gave us a call and they said, look, we'd like to port. What do we need to know? And so as we went through the exercise, there were a few things that came out that as we were going through, we thought it would be important to share with you. And so when you're porting a mortgage, there's a couple of things that you should know. First of all, when you apply for a mortgage, the banks will all use an interest rate to determine whether or not you can afford the mortgage, and that's pretty straightforward. But when you port a mortgage, some banks will use a higher rate to determine whether or not you can afford the mortgage. And so as an example, in this particular case, the interest rate on the mortgage was 3.1%, and she wanted to port it across to the new property. So we called the lender and said, look, one of your clients that we've helped would like to port the mortgage, and they said, great. Submit the application to us, but use 4.39% as the interest rate. And we thought, well, why would we do that? The interest rate is 3.1, we're porting it across, same amortization. But anyway, that was the bank's policy. So unfortunately, at 4.39%, this particular customer, by the bank's calculation, can't afford the mortgage. Even though the interest rate of the mortgage is not 4.39%, the bank is still using 4.39% to determine whether or not they can still afford the mortgage. So now the client's in a position of saying, oh wow, at 4.39%, I can't port my mortgage. Apparently I can't afford it, so what do I do? Well, with the proceeds that I'm going to get from the sale of my existing property, I guess I'm going to have to use it now to pay off a bunch of debt. And so now they're going to have to pay off debt so that their affordability comes more in line with what the bank would expect. And so that, the client wasn't ready for that. That obviously changes their plans a little bit because they had hoped that they could use that money for something else. So then the client said to us, well, why don't I consider just refinancing my property? If the bank is telling me I can't afford it because they're using this interest rate, could I just reapply for a new mortgage and qualify at 3.1% or 2.89%? And so, of course, we're going to help her with that decision. But that raises an interesting point because now she has a payout penalty. So the interest rate when she got the mortgage is 3.1. Today that same interest rate would be 2.89. So she's not going to be charged 3 months interest. She's going to be charged the difference between those two rates. So now she's faced with this decision of, okay, well, do I port my mortgage and pay off all my debt, keep 3.1%, or do I simply just refinance, use that money for the other purposes I had it earmarked for, and reset my amortization to 25 years? So if you're considering porting your mortgage, there's lots of things you should know. Jump on emilynow.ca to learn a little bit about what the payments are going to be, what the interest rates are going to be, and how porting a mortgage may be a good decision and may not be a good decision. And it'll be our team that can help you with that. So emilynow.ca doesn't cost anything to get started, doesn't cost anything to have an account, and we certainly would love to help you with what could be one of the biggest financial decisions you'll make in your lifetime. Canadians are taking on more debt. You read a headline like that and a guy like me holds his heart and says, oh, dear Lord, please let that not be the case. But Canadian press reported in the Financial Post that yes, in fact, Canadians are taking on more debt. And while that might be cause for concern, the article was actually a positive article. It talked about how even though Canadians are taking on more debt, delinquency rates have never been lower, and that's according to Equifax, the company that keeps the credit reports for Canadians, or one of the companies that does. And so not only are delinquency rates down, but consumer bankruptcies are down too. In fact, they're down 5% from the same period last year. So that's a pretty good thing. For me, there's a saying that I find myself quoting often, which is, make hay while the sun is shining. And it seems to me that right now, the sun is definitely shining. Literally, because it's coming in the window as I'm recording this episode, but even more notionally or proverbially, notionally that the economy is strong, the real estate market is stable, and so what does this mean for you? It means while times are good, generally speaking, that you should be using this time to make good decisions. Make investments and look to grow your net worth during this time of prosperity. And consider that one of the best investments you can make is actually paying off debt. Many of you may have heard if you have a credit card at 18%, there's no point investing in the stock market at 10% because you could immediately be earning 18% if you just paid off your credit card. So those are the sorts of decisions that you might want to consider while times are good. And I always remind people that Mother Nature has a strange way of acting sometimes, but she acts independent of us, whether we like it or not, and so do the markets. And so assume one day that the sun is going to go behind the clouds, and as it does, it's going to rain. And when it rains, it pours, and things generally don't go very well during those economic times. And so what do you do then? What if you lost your job? What if you lost your source of income? I would say don't only plan for a rainy day, but expect a rainy day. And so even though Canadians are taking on more debt and their delinquency rates are low, bankruptcies are low, the fact that they're taking on more debt would say to me, wow, what happens if the sun goes behind the clouds and we're faced with a bit of a softer economy in the next couple of years if interest rates go up? I mean, you can let your mind start to wander, but for you as an individual, make sure that you're planning for the inevitable. And if you need our help, of course, you can jump on emilynow.ca if you want to refinance a mortgage, take advantage of low interest rates, maybe refinance your property, purchase an investment property, or purchase a business, purchase real estate for your business. We'd love to help. So emilynow.ca, start an account. Our team will be happy to help. And that concludes this week's Emily Now episode. Thanks for joining us, and we look forward to seeing you next week.